We don't think the bull market's over. We do think that there's the potential for September to be seasonally weak, as it is, many, many years. And when you think about tech in particular, look, when you're having executives talk in front of Congress, we saw it earlier in the spring, the markets get a little bit jittery there. And when you go back to earlier this summer, there were some reactions to earnings that created volatility. So for us, the rally is not over. Technology is not over, but people are being more selective. And as we look toward year end, we actually think that some of the lagging areas are likely to work, such as financials and energy.
Michael, sometimes the most obvious things are what actually happens. I'm going to just give some of Michael's thoughts. Bonds are in a range 2 3/4 to 3, right? Inflation's not really overheating. The economy's growing at about 3%. There's some things that could disrupt this, whether it's trade maybe or something else. But I think that the way things look, it's pretty obvious, and you don't need to go much deeper than that to figure things out. Have I got that right?
Yeah, I think that's right, that there's a lot of headline noise, which we just spent 10 minutes discussing.
Right.
But underneath that, the economy is doing quite fine, and we think you're going to see that again on Friday with the labor market report. So yes, it's been a very consistent performance of, call it the fundamental side. So even take the trade story out of it. What's come out of consumers, what's come out of federal spending, the signal that's coming out of the labor markets, the domestic economy is doing fine despite the headline noise.
And JJ, you're like I said, we had two fixed income guys. So you don't, at this point, you don't see inflation just rearing its ugly head in a huge way anytime soon. That would be the wrench in the works, would it not?
Yeah, I mean, you laid it out perfectly.
I did?
Yeah.
As like a lodestar?
There's really, sort of my time is done based on what you said, but...
I shouldn't have read your notes. I should have just asked you questions instead of summarizing that. But I think that, sometimes we look much deeper at things, and this is just fairly obvious right now, isn't it? I mean, it worries me if it's too obvious.
Bonds and treasuries in particular are being buoyed by the uncertainty, which it always will find a bid for. But the news that everyone's talking about was worth less than a basis point to the 10-year overnight, and even now we are definitely range bound until we see either wage or price inflation. Now, Friday's numbers will give us another shot at average hourly earnings or any potential for wage inflation, but at 1 to 2/10, it's not going to move the needle, and it's not going to push 10-year to 3%. Now, 3 or 4/10, and if we approach 3% total on that average hourly earnings, then there may be a different story. But then on the flip side is we're almost guaranteed to see the Fed act on the 26th. Then it becomes less sure between September 26th and the end of the calendar year. And while there's no magic to that, there's still a chance that the Fed will remain hawkish or become hawkish, and that could put pressure on long end yields. But right now, until we see inflation, I don't see us busting this range.